Hello everyone, my name is Matthew Frailey. I founded Breakpoint Trades back in 2003. Since then, we've been bringing advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms like you see here with our SPY systems since 2003 for individual traders and professional institutions, which I consult with on a weekly basis. It's been a while since I've done a detailed YouTube video. Again, most of our work is for our clients through our email web service. So let's go ahead and get started with that. So what you see here is our back end. Again, each week I send out 5 comprehensive newsletters to our subscribers, covering the markets. We send out trade notifications for our systems, and we give actionable trade ideas. So there's a lot here. This is their back end recording, which shows up in web pages. So that's what I'm going to start here. And so let me go ahead and start this. Hello everyone, this is Matthew Frailey with BreakpointTrades.com. First off, I hope everyone has had a nice long 3-day weekend. As you know, the market was closed on Monday for Juneteenth. And I want to say happy Father's Day to all the fathers out there, myself included. So again, hopefully all of you had a great Father's Day, spent some time relaxing, getting away from all the market negativity and all the general news negativity. There's so much of it out there. All the inflation and gas prices, you name it, it's just endless negativity. So hopefully you got away from that a little bit, spent some time with friends and family. So anyway, this newsletter I'm also recording for a YouTube video. So I also suggest you guys watch the YouTube video because I can point out things that I can't with a cursor, in the standard audio newsletters. So this is the weekend newsletter. It's recorded on Monday, June 20th, 2022. 10 major table of contents here. Are going to cover quite in depth, by the way, on a YouTube video. If you're watching this on YouTube, these weekend newsletters, long form newsletters, usually take about 50 minutes or so. So quite comprehensive. Anyway, at the bottom here, I put some key observations because there's a lot of things we're going to talk about here. So first off, it was a strong down week for the market. It lost between 5 to 7.5% for the major indexes. That's a huge down move, okay? We have an ugly monthly candle, all right? Now, since early January, we've been calling this as a bear market before most people, and that call has been on par, okay? We warned about entering a bear market, in fact, last year in early December when we saw all kinds of major underlying issues under the market. Okay, that has come to fruition. Commodities, the other thing we called for was a bull market in commodities, and they have had a stellar year. DBC is up something like 37% or 40%, something like that. So we've done well there. So long term, we're in a bear market, guys. I am seeing some signs here that we are at or near a trade low, but don't lose concept of the long term. Once we do put in a confirmed trade low, remember, it will not be the start of a new bull market. It will simply be probably a decent bear market rally within the long-term bear market, okay? Fundamental reasons under the surface do not support us ending a bear market now and starting a new bull market, okay? So I want to get that out of the table. Now, these under here, these are what I'm seeing, the important things. The S&P has made it to some of our major target areas, which were 3650, 3600. That's the Symmetry from the 2020 low. Below that, you have the 50% fib retracement from the March 2020 low at 3500. All right. The daily charts are also in fifth wave moves. Those are final moves, but they can subdivide, and they still may need, say, an up or down movement before they complete, like an ending diagonal. And I'll show that when I get to the charts further below. On the daily chart, we have an 8 sequence DeMark. So that means Tuesday will mark a DeMark 9. That's important because those DeMark 9s have been marking trade lows in the market during this bear market. Okay, that's important. The monthly S&P monthly candle is nearing the lower Bollinger Bands. That's 35.29. So if we get a probe lower, that lower Bollinger Band target would be, probably a magnet. Longer term, on a good bear market rally, the middle Bollinger Band, as I state here, is now major resistance. We would get good short opportunity. Hedge funds have entered, I think, the second most short they've ever been. So that would provide some fuel for a decent bear market rally once we do get it going. All right. 10-year Treasury yield sports a big black candle doji along with RSI divergence. May pull back soon. So commodities also appear to be toppy. And, so along with a pullback and maybe commodities, which are due for a correction on a bull market, maybe a pullback in the 10-year Treasury yield, a bounce in 20-year bonds, that may help fuel that bear market rally. Okay, I am seeing some positive divergence on various indicators via the regarding to the S&P. I'm seeing some uncorrelation from the S&P to the VIX. So, another thing, bullish percent energy index has fallen to 9%. Energy stocks, the energy sector, has taken a major correction finally. But it's now at an area where you may want to look at picking up a few names. I don't think it's certainly bottomed yet, though, but it is in a good spot. All right. Now, the first thing, though, I want to get to before we get to the general market is our systems, our trade systems. So let's go ahead and jump to those. Actually, before I get to those, let's go ahead and look at the next items here. So item number 2 shows the index sector table, what transpired last week on Friday and, of course, for the week. Again, major losses for the week. Look at these down percentages for the indexes, down anywhere from 5 to 7.5%. Out of the major market sectors, we follow 20 of them, 21 of them. Every single one, of course, down strongly. Zoom in out a bit. You can see energy, which was, the big high flyer this year, down nearly 20% for oil services, 17% for XLE. That's a big move. Big losses on all the sectors here. Some double-digit losses here. Currencies, US dollar still remains very strong, but we do have some divergence showing up on the weekly. Cryptos all got smashed. Now they did on the weekend. It's interesting. This column here is actually updated for today, so this is kind of skewed. Actually, it's updated for today. Cryptos had a big sell-off on Saturday, but then they bounced back. If they can hold up here, that would help the market put in a bounce here. Futures are up as I'm recording. Commodities, big losses here. Look at some of these losses. Natural gas down 21%. Crude oil down 10.5%. Precious metals also down strongly. Bonds below, high yield corporate down. The market, TLT down. And the long-term rates are up. But I do believe we could see potentially a reversal off of those areas. Next. Item number 3 shows the economic news for this week. One thing to note, guys, we are going to be starting earnings season fairly soon, and that's going to be important to see how the companies guide for earnings. All right, let's be honest. There's a lot of concern about that. Microsoft warned about the U.S. dollar strength hurting their earnings. So certainly we could see a lot more of that. But if some of the analysts raise or lower their guidance quite a bit before earnings, maybe they'll be able to at least come in okay. But we'll see. All right, let's first off, before we get into the rest of the market, let's talk about our systems. So this image below, I'm going to zoom way in on this. This shows the subsystems for our SPY system. We have 12 individual subsystems that look for long entries. They're reversion to mean, which means, when you're downtrending strongly, if things get too stretched, they look for low risk buy opportunities. They get in, they get out. They don't look to hold for major swing trades. They're mostly in cash. So last week, the bear long, that's a long condition that occurs in bear markets, took a long entry. In fact, it took 2 entries. All right. This system has about 87% winning trades, and it's one of our better systems. Okay. All the other systems are in cash at this point. Now, should the market have a decent bounce here, we'll likely see this system exit for a nice winning trade. If we go a little bit lower, it's possible we could see another entry on this system. But otherwise, the systems have done very well this year. We've had 28 trade signals, most of them winners, and I send out these trade notifications to our subscribers when these do a trade. Next. Image number 5. So I also send out trade notifications using the same systems, but on ES futures. You don't have to trade futures, but you can, or you can just trade ETFs, whatever. But the same bear long also triggered on ES. Now, you might be wondering, do they always give the same trades? Because, they're essentially the same. They're highly correlated, SPY and ES. No, they give a lot of different trades many times, and it's best to send out trade notifications to all these. Collectively, we have 21 systems. We have the other systems that look for shorts, none of which are in a trade at this time. So, again, systems have done well this year. They're designed, or they work better in high volatile conditions, like bear markets. They do best in those areas. So if all you did here was trade the systems, I think you'd be very happy. Okay, that comes with membership. Okay, systems overall have about 80 to 90% winning trades, and trade history going back to the mid 90s. All right, let's go and get back to the general market. So, before we get to the general market, I'm going to cover some other systems here. So, in addition to the reversion to mean systems, we have these trend following type systems. So our KISS, we call these KISS systems. They're designed to keep you invested in bull markets. This is our weekly version. You can see how it went long back here in the early 2020 timeframe. Kept you in. It would have stopped out there in early January. And again, we're in a bear market. So these KISS trend systems will mostly stay in cash, especially these weekly ones. So they're nice. They were a nice safety net. They would have got, if you were following this, you'd have gotten your portfolio 401ks out of the market in January, and you'd be happy in cash where everyone else is crying. Next. Chart number 7, here's the daily version of the KISS system. It's a little more volatile, but it's done well. It got out here in early January. It did try to get in long one more time in March, but it was in briefly here. You can see the DVTs, and it got out. And it's been in cash ever since. The DVTs, think of those as trailing stops. They're ratcheted up as price goes higher. But in bear market conditions that I discussed, the daily KISS systems are mostly going to be in cash. And when they do go long, they're probably not going to make much. They either make a little bit or there'll be whipsaws. It's better actually to follow the reversion to mean systems in a bear market environment. Otherwise, since I have the indicators on here, I will note that we do have some divergence here on, notice the moving average ribbons, how wide they are. Yeah, but this is the second derivative of the moving average ribbon. So you have some positive divergence here, kind of like you did back here, and you got that bounce opportunity. Next. Chart number 8, here's our other custom indicators. These are the multi-time frames daily and the intraday charts with the cycles. Note, one thing to note here is we have an end of bear cycle here. Got a little bicycle right here. We had a bear cycle a couple weeks ago that obviously played out. So that's quite interesting, along with that DeMark 9 that will be showing up on Tuesday. Could be showing that we're nearing kind of an end of this short term. Shorter time frames, 60-minute, 120-minute. The ATR is your resistance now. Okay, let's go back to the standard charts, and we're going to look at the indexes and look at the bigger picture. So this chart here, item number 9, is a yearly snapshot of the major indexes. And look at these down candles this year so far. So again, each of these candles are 1 year. So far the Dow down 17.8% for the year, S&P down 22.9%, NASDAQ 31%, IWM small caps 25.5%, and DBC commodities up 38%. TLT, which is not showing up on here, that's 20-year bonds, that's down about 20%. Think about it. A lot of, brokers money managers who put their clients in, diversified portfolios. Bonds are supposed to protect their clients during bear markets. This time they're getting a double whammy with bonds down sharply and the indexes down sharply. But you can see commodities, super bull market this year, bear market in the indexes. But look at these big down candles so far this year. Next. Chart number 10, here's a monthly view of the S&P. This is a chart Steve and I discussed last fall. We discussed it in nearly every newsletter. We harped about how wide the moving average ribbon is here. Again, if you're new here, maybe this isn't something that stands out to you, but think of these moving average ribbons. They ebb and flow. When they pinch, those are your areas where you can get strong moves, energy's pent up. And when they get too expanded, think about it, it's kind of like a runner who's exhausted themselves. That trend is about to end. And our comment was ribbons are too wide, wider than we've ever seen, and that is going to have to be worked off with a large price correction and time, hence a bear market. You can see our comments here, and I updated it here, but this is obviously played out. Now, it is starting to pinch here. Again, it's not, to me, worked off. You can see, even though the BPTMA has come into here, overall, everything is still pretty wide if you look at the past history. But it is pinched here that, maybe soon we'll see a little bounce. But my thought is that it will do something like this. Another thing to note on the monthly charts, the lower Bollinger Band, if we get another little downside probing, that's likely a little support area. Now, on a good bear market rally, this middle Bollinger Band in bear markets tends to act as resistance. So if we were get back up into this area on a bear market rally, to me, that's an area to put on heavy shorts. Again, that could take a month or two after we bottom. But those are what I see short term. Okay, let's move on. Image number 11, here's the monthly view of the index. Again, look at these down candles. Last month we had those big dojis, and that was a promising, but we couldn't rally, and everything just puked after that. As you can see, you could notice your lower Bollinger Bands here. We're actually below the lower Bollinger Bands on the NASDAQ and the Russell. But one thing I want to point out, guys, the previous bull market, which was from 2009 to late 2021, you could see how we really ended in a textbook blow-off. What we're trying to point out here is the uptrend slope here. Let's say this is like 30 degrees. Notice on that pandemic, the slope literally doubled in value. Classic blow-off. And ultimately I think this whole blow-off move will probably eventually be worked off in the bear market. Not in one swoop, but over time. Next. Chart number 12. Here's another monthly view of the indexes. This one, you could see the 2009 bottom. And again, you can see how that slope changed, that blow off. But here I added fibs to the 2009 lows to the highs here. And the Dow obviously nowhere close to its 38% fib. S&P still off. That's one of the major targets of this bear market is this 38% fib, right around the 3,200 area. NASDAQ's already there. Generally, when I looked at bear markets, I looked over the last 100 years. Bear markets always retrace at least 38% of previous bull markets. So that's your minimum long-term target. I do think, though, since this was kind of the everything bubble, crypto, NFTs, Rolex watches, you name it, everything got pumped to hell. I think we're going to have to work off this whole blow-off move. I mean, I wouldn't be surprised if overall we see the S&P down into, lower 2000s, mid 2000s before it's done. But again, not right now. Eventually, maybe next year. Next. Chart number 13, here's the quarterly view. Boy, look at these down quarterly candles. Crazy moves. You can see how that blow-off move is being unwinded. Next. Chart number 14, here's the weekly view of the indexes. Again, solid last two down weeks. As you can see here, the fibs. These fibs goes back to the March 2020 low. The Dow's only at the 38% fib. The S&P, it's been reacting off these fibs. It bounced initially off the 38% fib. It's obviously lost it, but the 50% fib here, 3,500, that would be a target on an immediate move down. Remember, that also matches the monthly lower Bollinger Bands. So that's a big area, I think. I don't think we're going to go down to this 61 area unless we just absolutely crash here, which is possible, right? But, you know, not unless we crash. I think this area would be a good area to put in some sort of trade low initially. Let's see where the other indexes are. Next. Chart number 15, here's the daily view of the indexes. So we had a little trade low in, mid-May. We moved up. We formed the sideways pattern. This was your area to short, guys. Once you broke this, on the S&P, it's 40.75. It was a very easy short. Hopefully some of you took that, shorted that move. Down in here is not the area really to be short, unless you just have some stragglers and you're willing to give it a little room. But, this is not your good low-risk area to be short. Up here was an awesome short. You can see we're at the lower Bollinger Bands. We have some dojis here, short term. We'll see if we can bounce from those or not. Next. Let's move back to the S&P charts here. Specifically, we'll look at those first. So here's the monthly view of the S&P. Again, you can see the, this bull market, which started in 2009. It ended, end of December, early January this year, fifth wave. And we've had a healthy correction down over 22%. We're kind of, you can see we're the bottom, two-thirds into the channel, a little less than that. Longer term, this trend line here would be a target, 38% fib, like I said. But again, longer term, I still wouldn't be surprised if we were to retrace this whole blow-off move eventually. If this bear market were to last, say a couple years. Next. Chart number 17, here's a logarithmic chart. Shows you those same lower trend lines. Here's your 61 fib. And moving average ribbon, you are getting a pinch here. It is still bullishly stacked for now. But maybe that's an area that is soon calling for at least some sort of oversold rally attempt. Like I said, if we were to get one in here, lower high would be my thoughts, and then down again. It's like that. Moving on. Chart number 18, here's another monthly chart of the S&P. This is a linear chart, but these are some of our longer term targets down in here. These demand zones, 50% fib, you can see right there. Next. Chart number 19, here's a monthly chart of the NASDAQ 100, and this is going back in time. So this is showing, those of you who've been around long enough, you remember the tech bubble of the 90s, ended in early 2020. You essentially, in that bubble, you had a strong bull market in the 90s, and it essentially went parabolic. You had that blow-off move, okay? Just like we did recently from the 2020 March low to end of 2021. That was a blow-off move. This is a blow-off move as well. Little stronger blow-off move, I think, but still blow-off move. Notice that whole blow-off move was retraced in that bear market and then some. That's why I think, we could see our, the blow-off move from the 2020 low to the highs eventually erased as well. Next. Chart number 21 or 20, here's a weekly view of the S&P. So we're going to move down to smaller time frames. You can see the big down candle. So a couple things here. We do have a little divergence on the RSI to note. Symmetry target, 3,600. That's basically the move, the correction from February to March 2020 subtracted from the highs. That comes in right here. You got your 50% fib here. So you got a lot of areas right into here. Okay. Longer term, some of our targets are down here around 3,200. Unless we crash right now, which is possible, I don't think we get down to here, but if we crash, certainly that could be a target as well, short term. Next. Chart 21, here's a daily view of the S&P. What I want to show you here is the DeMark. The mark sequence is very well known. If you don't know about it, you can Google it. But, you know, the market this year has been bottoming on these DeMark 9s. You can see them here. And as of Friday, we had a DeMark 8 sequence. So Tuesday's candle will start a 9. So that's something to note. That could be indicative of a trade low. This here is a little Elliott wave indicator. It's showing you're in some sort of fifth wave, which I agree with, but the fifth wave may not be done yet, as I'll show below. But we do notice we will have a DeMark 9 on Monday. Next. Chart 22, here's the daily ES. And you can see ES is up nicely. It was up 40 points earlier before ES closed. So we're looking at a potential gap up on the cash. Anyway, you notice you have your DeMark 9 already, remember. So you'll have a DeMark 9 on the S&P cash on Monday. Next. Chart 23, here's a daily view of the S&P. Okay, and you can see what I'm focused on here is notice we can, from the March high, you can count 5 waves down. So we're in some sort of fifth wave. Doesn't mean it's done yet, but it's an area where you're starting to look for potential bottoming signs. This was one of our major targets here, which we filled around 3650. If we get a little lower probing, this 3600 area, that would be a good target. You could match into September 2020 highs. You also have your 50% fib here from the 2020 low at 3500. Okay. Next. Chart 24, here's another daily view. It shows you the same chart. Again, you can see how this bear market is unfolded. A, B, C, and 5 waves here. We're working on this wave 5 here. So a couple things I want to point out. First off, you got 2 major gaps here. This gap here, these are very important, gap of recognition. On this gap, you had a spike on the NYSE tick at 2100. That's one of the, I think it's the 4th largest in history. So that's very important, this spike. Okay, it's going to be big resistance right up in here. Now what I'm seeing here, we're showing you a possible scenario. First off, this downtrend line here, this dotted, this is a resistance. We got to get over this. You need to get over this doji. But if we can get over this, one thing, this could be an ending diagonal. So what you could see here is a bounce up, lower high, and a move down to complete a wedge, and then a rally. This also shows you that you may need a couple of them and then complete. But either way, we're looking for an end to this move here. Whether, you know, we get 1 move down or 2. Otherwise, we're looking for an immediate up and then down. Okay. Next. Chart 25, here's a 60-minute view. First off, again, you can see how we were trading in that range a few weeks back. Once you broke this 40.75 area, that was a beautiful short. Dumped. We do have some nice MACD divergence, RSI divergence on the 60-minute time frame. This lower trend line, which was acting as support on all these major lows, is now resistance. So again, price needs to get over this. It could just be up and stall here and come down again. All right. It could just, what you want to see is you want to see it get above this initially. Okay. Next. Chart 26, there's a 30-minute view. Shows you this wedge-like that I just showed you on the daily where, again, we're obviously in some sort of fifth wave, but the fifth wave, remember, it's going to have multiple waves. You know, it may need a down move, then up, or it may need like a, 3, 4, 5, and then up. Next. Chart 27. 15-minute view just shows you this wedge-like pattern now. As of futures, I mean, this would argue for an immediate move down, but right now futures are up, so we'll see how they open on Tuesday. Next. Chart 28, here's a 10-minute view. As of Friday, it had kind of a bear flag, head and shoulder look. Again, it's going to depend on what futures do. If they're up sharply on Tuesday morning, this will obviously be negated. We'll just gap up over it. This area is obvious strong resistance now, 3705. So we'll see how this opens on Tuesday morning. Next, moving on to the triple Qs, chart 29. Here's the weekly view with the fibs going back to 2020 lows. So not too far away from that 61.8 fib, 256.60. You also have the 200-week moving average. So if we were to get a lower probing, to me, this is a huge area. I would consider going long in here, at least for a trade in a bear market, okay? That's the major fib. Next, chart 30, here's the daily view of the triple Qs. You have this kind of wedge look pattern. You do have divergence here on the MACD. Again, what I don't know is, you know, if it's going to need some sort of move like that before finally bottoming. Next, chart 31, here's the NASDAQ. It basically shows you what I just illustrated. Okay. We do have some MACD divergence here that would allow it. Next, chart 32, here's the 2-hour view. This also shows you the same thing. Now this allows for an immediate rally up, right? Especially if futures hold up. Then we get a down move and then up. So if we get a good rally early Monday or a Tuesday, if we don't, like, say, get above this gap here, I would look to fade that rally, because then it would be better for the market to come down again like we show. We do have some nice MACD divergence at the lows, though, RSI as well. Next, chart 33, here's the KISS trend system. This is the S&P. Let me move on. Should have been the Qs. And this is also out of order. Sorry about that, guys. Anyway, the Qs of the cycles and everything show the same thing. So let's move on. Let's move to the Russells. Here, IWM weekly view down 7.5%, down the most. This started weakening late last year before the other indexes. Lost this big weekly support, back tested it, and it's been down ever since. It did fill a gap here, which was the target. This would be my next supply zone below as well, should prices go directly lower. Next, chart 36, here's the daily view again. Bear market, every bounce, every rally so far has simply been ABC, ABC, ABC. It's been profitable to short those C moves, as you can see. This area now here is resistance, this 168.50. Next, chart 37, here's a 60-minute view. Had a little wedge look to it on Friday. All right, that does it for the indexes, guys. Now let's look at some indicators. Chart 38, here's the NAHL plotted as a cumulative. This is one thing that was given a big warning last year of a bear market. You can see when this flipped right back down here, and this was in December, and lo and behold, that was a good signal. That occurred before the market officially topped. It showed you things were ugly underneath the surface, negative breath. You can see a potential falling wedge now, though, forming on the NASDAQ. Next, chart 39, here's another one that was given a big warning last year. This is the NASDAQ. This is the 52-week highs minus the lows. It went negative here, and I said we're in a bear market. It's likely to stay negative, and you can see it has never went back positive, except for one little bar here. Got a little oversold last week when it went below its lower Bollinger Bands. Next, chart 40, here's the VIX. So the VIX, as you know, has been unable to spike to get over this area. There's a lot of technicians out there that are looking for the market to puke and for the VIX to have a big spike up to the 50s to finally wash things out. And I would certainly love to see that, but I just don't know if we're going to get it the way it's acting. The only way we're going to get this is if the market absolutely pukes, where we see 300-400 points down. Okay. Otherwise, this area has been resistance on the VIX. Now, one thing I want to show here short term, this is the correlation between the S&P and the VIX. And it's getting uncorrelated here. You can see sometimes these uncorrelations occur near highs. Sometimes they occur near trade lows. So we're getting it down here. Maybe we're near a trade low. Who knows? Next. Chart 41, here's a 60-minute view of the VIX. Just keeping an eye on this in case it wants to form some sort of coil. You can see this falling wedge obviously played out from mid-June that we showed. Next. Chart 42, here's the VVIX, and this has been a useful indicator. When it gets uncorrelated with the S&P, you can see it got uncorrelated with the S&P back here in early June. It gave you a pre-warning before that big market dump. You can see it's been pretty dang reliable, catching a lot of these highs and lows at times. Next. Looking at some other indicators, chart 43, here's the S&P versus the BP-SPX. Back in mid-May, we had a pretty good positive divergence between the two. Right now, we don't. Okay. Next. Chart 44, same here for the S&P versus the advanced decline. We also don't have a divergence here. We did, though, back in mid-May. Next. Chart 45, here's the NYAD versus the S&P. Also don't have any divergence here like we did back in May, though we do have some RSI divergence with respect to the NYAD. Next. Now, some indicators that do have some divergences here showing up. Here's the S&P versus emerging markets. Emerging markets have not made a new low yet. Okay. And you can see in the past when these divergences show up have been, they've given you pre-warnings. Like here you had a lower high in emerging markets. That led to a correction. Same here. Led to a correction. So we do have a positive divergence here. Next. Chart 47, here's the S&P versus China index. Here's one of the China ETFs. China stocks have been moving strongly up. So you have a big positive divergence here with China and the S&P in the Chinese market. Next. Here's a couple individual names in the China stock. Alibaba. Got this long trend line all the way back to 2020. We did break it. Volume looks interesting here. It looks kind of interesting, especially if the market puts on a little trade low here for a bit. This could be a good trade. Next. Chart 41, K-Web, Chinese internet, same deal. It's been exhibiting relative strength. We pointed this one out back in May there when it gapped over this downtrend line. Next. Chart 50, here's the S&P versus the 10-day inverse put-call ratio. And this has been a pretty useful indicator when you see divergences on this put-call with respect to the S&P. You can see it had a big divergence here back in end of December, and that led to the correction. You had a positive divergence here and end of February that led to a rally, and now you have a big positive divergence between the two. It looks set to have some sort of potential bounce. Next. Chart 51, here's the S&P versus the XOP S&P ratio. They tend to move together. You also have a divergence between these two. Notice that. Next. Chart 52, here's the NAHL, NASDAQ new highs minus new lows, and some of these other indicators. So notice you have divergence here on the NAHL with respect to price, positive divergence, and you have a positive divergence on the percentage of NASDAQ stocks that are above their 50-day moving average. Next, chart 53, here's the NASDAQ McClellan oscillator. You have a positive divergence here with respect to this. Next, chart 54, here's the S&P McClellan oscillator. So quite a bit of indicators here are now showing divergences. So take note of that, guys. All right, let's move on to bonds and rates. Chart 55, high yield corporate. It's been moving with the market. They started weakening before the general market, actually, and they've been very weak this year. Anyway, for now, they've bounced off this extended lower trend line. Got a lot of work to do, obviously, though, still. Next. Chart 56, TLT 20-year bonds. Remember, they're down about 20% this year. It's not been good to hold these in your portfolio. This does have a little divergence, low potential down here. Let's take a look at the weekly. So chart 57, here's the weekly view. We have a big hammer doji candlestick here. This, along with some RSI divergence, this has an opportunity to put in a low here for a while. Now your trigger, in fact, you could go long this. Your long trigger would be taking out the high of this doji by 1 penny. So say 112.85 and then put a stop at the low. Next, chart 58, here's the 10-year treasury yield. So on the opposite end, this has a big inverted black candle doji. That looks like a topping candle, and you have your divergence on your RSI. Moving average ribbon's a bit too wide here. So what I'm trying to point out, guys, is interest rates are in a place to possibly pull back. Bonds are in an area to bounce. Maybe that could help fuel a bear market rally. Next, chart 59, here's the daily view. Next, chart 60, here's the monthly view. I need to update these comments. This is actually a 40-year downtrend line, which interest rates broke. They ran into some resistance up in here. Pull back, though, will form a higher low, I would think, and then eventually go higher long term. But like I showed you on the charts above, they're set up to at least maybe pull back here short term. Next, chart 61, here's the yield curve. So, you know, there's a lot of talk about is the economy going into a recession. I think that's crazy talk. I mean, isn't that a given? You know, it hasn't went into recession yet officially, but how's it not going to, guys? Common sense. Just common sense, just like we knew inflation wasn't transitory, you know, over a year ago when the Fed was talking about all that crap. Anyway, this did invert briefly here. So that's enough that it still pretends eventually we will have that recession. Next. Chart 62, here's another view of this yield curve. This is the difference. Same deal. When it gets below here, it's inverted. And again, it was briefly inverted this year for a couple days. Next. Moving to the market sectors. I'm not going to look at all the market sectors. We follow 21 sectors. Most of them have similar looks. But we will look at a few individuals. Chart 64, here's XLE Energy. As you know, this has been in a bull market this year. I had a very bullish call in this in January. And finally had a major pullback last week, down 17.16%, as you can see. XLE Energy. It's actually now back to the 2014 lows. You can see how back here in January, it broke this long downtrend line. That was the time to buy it. Okay. Now, it's had a nice correction into potential support. I don't think the correction's done. I think it kind of needs an ABC move. But could this be an area to scale a little bit in just because it is quite oversold? I think so, depending on your risk profile. Next. Chart 65. There's the XLE S&P ratio. You can see how it was set up to a bullish ascending triangle, which broke out in December. Again, very overbought up in here. Next. Chart 66, here's the daily view of XLE. A couple weeks ago, we pointed out this black candle doji. We said that looked like a topping pattern, especially if it had a down candle, which confirmed a bearish evening star pattern. This was an area to get out of Dodge or short. It's actually broken the channel. This is a good thing because we're getting that much needed correction. Next, chart 67, here's another view on the daily. When I'm thinking of this initial move down, I can only count one wave. It's a wave A. Eventually we'll get a rally up, form a lower high, maybe this broken trend line, maybe the 50-day moving average, then come down again, maybe near the 200-day moving average. This, to me, would be a real good swing opportunity if we get something like that. Next, chart 68, ERY, that's the double inverse ETF for energy. I put this as a long idea. A couple weeks ago, this falling wedge, and this played out beautifully. Trigger was about 34.50 on this. Sucker rallied up to 53 bucks. One hell of a trade. Next, Chart 69, here's the bullish percent energy index, BPDR. You know, when this thing was up at 95, 100%, those are the areas to look to take profits on energy stocks. It was at 95% a few weeks ago, sky high. I said, don't buy energy stocks. Now it's come down to 9%. So it's really oversold. This is the area where you look to pick up, you know, some initial positions. This is lower risk down here. But again, like I showed you above, I don't think the correction is ultimately done. I think maybe it'll bounce with the market, maybe come down again, and then you get your better bounce. But in case that doesn't occur, that's why I think it may be good to look for some initial entries, small entries down in here, perhaps, as starters. Next. Chart 70, biotech. Here's another index sector that interests me. It's been in a bear market. It started in early 21, I mean. So it's been in a bear market the longest. You got a perfect double bottom down here, MACD divergence. This looks lower risk with a stop down here. Next. Chart 71, XLC, communications sector. Again, we'll see how if the market does put in a bounce, and all this stuff will bounce. But you can see how hammered this has been this year. Next. Chart 72, financials. A couple dojis here. Moving average ribbon is quite stretched. Next. Chart 73, there's the weekly view. You can see we had that rounded top on the weekly. We've come down to at least one support area. Longer term, these are my targets down into here. I'm thinking we don't get down to there now, but eventually over time. Next. Chart 74, here's the IYT transports. This is interesting. You have a potential falling wedge here. Not a traditional wedge, but it is a wedge-like. And you do have a nice doji here as a trigger. RSI divergence. Next. Chart 75, XME, metals and mining. We put this out as a short a couple weeks ago. That obviously played out beautifully. Next. Chart 76, real estate. We know what's going on with real estate. Obviously, heck of a correction this year. Next. Chart 77, home builders. Housing market, as you know, has been on fire. And with rates going up to over 6% for the 30-year mortgage, we're obviously seeing a big crash in this area. Take a look at this. Here's your next support on home builder index right here. Next. Chart 78, there's the daily view. Little doji candlestick here on Friday. Finally, chart 79, XLE or XLI industrials. Big doji on Friday. We are nearing some of our target areas down into here. So there you go on some select sectors. Let's move on to commodities. Chart 80, DBC, commodity ETF, weekly view, down 5.25%. Again, it's been a bull market. I talked about that last year, that this would be a bull market this year. And I talked about a bull market in 2020. That's where it started. It is very stretched here. This looks like it's due for a correction. It's still holding the 9-week EMA. Once it loses that, then I think it will start. Watch the MACD as well. Hasn't crossed. You can see this divergence building. Next. Chart 81, here's the monthly view. Now this chart really puts this into perspective. Now the end of the month isn't here. We're only mid-month, but we have this doji here, and it's an inverted hammer. This is more of a topping pattern. If it were to close like that, you know, this area to me then could use a correction. Again, it's in a bull market, so it'd be a correction in a bull market. So a correction here could, I think, would happen while the general market put in that bear market rally. Make sense? Next. Chart 82, there's the daily view. 50-day moving average, here's your first target on this pullback. If we lose that, this would be your next target. And you can see the fibs. Next. Chart 83, here's the CRB to the S&P ratio. Earlier this year, I was pointing this out. In fact, late last year, how we had this multi-year base forming in a ratio. It suggested a major bull market started in commodities. You can see how the moving average ribbon expanded. And this was up last week, but it looks stretched to me in the short term. Chart 84, here's the shorter view of this. Black candle here. Look how wide the ribbon is. So to me, it looks like commodities are getting a little bit overdone here short term. Next. Chart 85, crude oil. Finally a big pullback, down 10.5%. That's the weekly view. This is your long-term support. You know, if this continues lower, maybe we'll get a little bit of reprieve on gasoline prices. Next. Chart 86, there's the daily view. Again, big correction over the last week. Losing this would allow this to, you know, if it loses this channel, it could easily pull down to the 200-day moving average again. Next. Chart 87, natural gas. Broken down here recently. Once it lost this, this was your short opportunity on this back test, retest there. You can see down again. This looks lower still. Next. Chart 88, copper, down 6.5% for the week. Again, we knew this all looked vulnerable. You had a symmetry break, lower high. Longer term, these would be my targets below. Next. Chart 89, DBA, agriculture. Momentum's also weighed on this as well. Still holding this trend line support for now. If it loses that, 200-day moving average could be a target. Moving on to cryptocurrencies. Chart 90, Bitcoin. Bitcoin has been wild action. So first off, this weekly chart. I drew this up quite a long time ago. I said my target was down there around the 12,000 area from Symmetry. That takes this move, subtracts it from here. Notice how it conveniently measures right to here. Also this big horizontal support. Longer term, I think Bitcoin's going down to here, maybe even down to the, say, 10,000 area. So now the worry here, does it do it now, or can we, you know, have some sort of little bounce here for a bit and then do it? That's the question. If this were to, it is off the lows this week. It was strongly down over the weekend, which was a concern, and it's bounced back. But if this were to dump, that would obviously be a reason to take the market general indexes down again, because they kind of follow this. Next. Chart 91, here's the daily view. Clearly that bear flag played out. Again, you can see it's off those lows on the weekend, but boy, still got a lot of work to do. Next. Chart 92, Ethereum, same deal. This is a great short up in here. Next. Chart 93, US dollar, weekly view, up 0.3% for the week. Now, hell of a move off this double bottom back here. And almost has a big cup and handle look here. We do have a little divergence up in here, though. Take note. Next. Chart 94, here's the daily view of the dollar. Again, we do have a potential MACD divergence, as the MACD has not kept up with that recent high. Next. Chart 95, there's the bigger picture view of the dollar. This is kind of like a big area here going back to the 90s. You know, it's struggling right up in here for now. Next. Chart 96, Japanese yen. They have absolutely hammered their currency. Look at this thing. It's back to essentially 2001 lows. Kind of a thin zone here. Air pocket. Losing that could go back to the 98 lows. This, longer term, is a disaster waiting to happen. Remember, guys, they are still in full QE mode. Next. Chart 97, there's the weekly view. You do have some RSI divergence here, so the hope is it can bounce here in the short term. Next. Moving on to precious metals. Chart 98, gold. Gold certainly hasn't done crap this year. You know, one thing it needs the GDX-GLD ratio here to curl up. It needs the stocks to outperform, and they have not been. Yeah, the ribbon pinching here, this is your major support. We're still holding that. We had a little double top back here earlier in the year. Okay. Now, gold seasonality-wise tends to be bullish in July. My hope is gold can hang around here and then start to build a rally into July seasonality. We'll see. The onus is on the bulls. Next, chart 99. Here's the monthly view. Again, you can see that double top. MACD was unable to break above its signal line on that push. Again, if it can hold these areas in here, it's okay, but it needs to. Obviously, this was the area to buy it on this break of the multi-year base. Next, chart 100 daily view of gold. Again, just chopping around here, not doing much. Next, chart 101 silver monthly view, as I showed before. This area is your big support for silver long term. Next, chart 102 silver on the weekly. Next, chart 103 silver on the daily. Could be a big bear flag. Next, chart 104 GDX. Gold stocks also haven't done much. It's been better to sell. Hopefully you sold those earlier this year. This is your kind of big support zone. We're still holding that for now. Next, chart 105 daily view of GDX. Again, still kind of hanging around here. You need the ratio to turn up. This area has just been pathetic, like I said. Next, chart 106. Here's a 60-minute view of GDX, this channel to monitor. Next, chart 107, Newmont. This one's been holding up here, and it's near the 200-day moving average. So out of the individuals, I do have a little interest in this one. If it can hang on to here, also watch this ratio. All right, guys, now let's look at a few random stocks. Chart 108, Amazon, down to this, back to this support area. This is your long-term resistance. Next, chart 109, Amazon on the long-term view. Long-term, these are our targets below. You had a bearish symmetry break back here. Again, things have really unwound during the bear market. Next, chart 110, Netflix. We all know what's happened to Netflix. There is some longer term support down here at 125. Look at this sucker. It was $700 back in late 2021. Next, chart 111, AMD, one of my favorite stocks from last year, last couple of years. Also had a major haircut. Longer term, this is a big support. And this could be a target over time. Next, chart 112, Tesla. Hopefully you guys took profits on Tesla when it was over 1,000. Anyway, longer term, these are your supports, 500, even down into here over time. Next, chart 113, GBTC follows Bitcoin. You got a doji here to use as a potential aggressive long entry with a stop at the low. We had it as a bear. We had it as a short back here, guys. So this would be an aggressive long. Your stop is at the lows if it triggers. Only if it triggers. Next, chart 114, Cleveland Cliffs. You got a doji here. Your trigger would be the high of the doji. Stop at the low if it triggers. Next, chart 115, CVNA, long idea mine from last week. It's trying to build a little base here. This sucker is volatile. It was up 13% on Friday. Next, chart 116, TUP, long idea from last week that's holding up very well. Again, guys, once the market does put in some sort of or confirm a trade low, you can pretty much buy anything. Some of the FANG stocks like Apple or, you know, UPRO, stuff like that. So my suggestion would be to keep your what you buy, if you buy anything to play a bear market rally, keep it pretty simple. All right, guys, that'll do it. This newsletter's been long enough. Looks like 1 hour. That'll do it. Enjoy the rest of your Monday. See you tomorrow. Take care.